Welcome, everybody, to our next webinar here at JFD Brokers. My name is Stefan Friedrichowski, and you know that you just can call me Stefan whenever you have a question. Just use the GoToWebinar control panel, because there you can get in touch with me direct during the webinar. But even afterwards, keep in mind that email address here already on the first slide. I know my last name is quite complicated, but maybe a screenshot might help, or just that you know, as always, I have uploaded the slides for today's webinar about mean reversion trading strategies already, and that means you can download those slides once again in the GoToWebinar control panel. Yeah, today, the 28th of June 2017. So nearly half year is over for the year 2017. But anyhow, stock markets are as always complicated, as always tricky, and how to beat it, to beat them a little bit, that is part of today's webinar. Mean reversion trading strategies. But before I jump into the topics, just, you know, I have always to show first thing that slide because we talk about trading strategies. But finally, when you trade on your own. I think that is quite well understood and quite well known. So, but anyhow, that is done. But back to our topic, mean reversion strategies. You might have seen some advertisement for that webinar, and have simply to mention that ad here, mean reversion trading setups, because the guy who has built up that picture for LinkedIn and Facebook has really done a great job, because what you see here is already part of the strategy we talk today. You see some spots here within that chart, and you immediately realize, hey, that would have been perfect entries for something reverse. So perfect entries back to the normal. And indeed, exactly that is a kind of strategy we want to create within that webinar. And that is a mean reversion strategy. You can think already about, hey, there's a mean value here in the middle, and the price goes always back to that mean value. Later, I will call that the fair value, but it's that nice that we have that good advertisement picture here. Therefore, I simply mention that here as well. So that is LinkedIn, but I think you can find it, the same picture on Facebook as well. But not talking about advertisement anymore here. We go direct into the topic of today. So what are the specific topics? Because you know that I like not only to talk about the trading strategy itself. I would guide you a little bit of how to come to those kind of strategies. And today's topic, or special topic, before we really start with the mean reversion strategies, is how to optimize trading strategies. And that gives you a short insight into some key figures I typically use whenever I deal with trading strategies, especially if I optimize those trading strategies. We need some special key figures in order to do that kind of job. And finally, we boil it down to one single key figure, and how to do that and why, especially that kind of key figure, I want to share with you in the first part of this webinar. But then we go directly into the basics of mean reversion strategies in general, and finally, specifically, And as already done with some other strategies, I will present results in Excel here. And I hope that maybe you find it interesting to do trading strategies already with Excel. And you know that I'm more than willing to share those Excel sheets with you as well. So whenever you want to have those sheets, just send me an email. And finally, on the last slide, once again, there will be my email address. But if you simply miss that part, you can write to support of JFD as well. Good. So that's for the interaction. But first of all, I want to deal a little bit about optimizing trading strategies. Let me introduce in general what I do here. Whenever we talk about trading strategy, then we talk about fixed rules. Because when I create a strategy, there's no human input factor, no human impact on the trading activities. So finally, everything has to have absolutely fixed rules. So that means entry and exit of a trade is well described. And we need that, definitely. And we need both the entry and the exit. The exit might be a stop loss, might be a take profit, or whatever. But finally, it's important that every trade has to come to an end. So therefore, we need an exit of that trade. And we need rules behind that. In most cases, when we talk about trading strategies, like I talk here about those trading strategies, we have some descriptive parameters. That sounds a little bit abstract, but what I simply mean is, for example, we have a trading strategy which is based on EMA. Then that EMA period is one of those parameters. And since every trade should have a stop loss, and in my case, it always has a stop loss, then that stop loss distance might be a second parameter. For example, in percent of the price. Percent is not that bad because you know that, for example, if we talk about DAX, today DAX is about 12,000 something, but years ago it had been at 2,000. So talking about stop losses in fixed distances like 20 points would not be a good idea, especially for DAX. At Forex, sometimes you can live with fixed numbers, but even there, you think about, for example, Euro, Japanese yen, which has been at 160, today is about 120. So percentage description would be much more appropriate. And finally, we might have a take profit, and the parameter to describe that take profit might be a risk-reward ratio, for example. So we have, in this case, 3 parameters, and that means finally we have 3 degrees of freedom for that strategy. And the task now is to find those values for EMA, stop loss in percent, and risk-reward ratio, just as an example, for the best results. But now the tricky part is already there. What are the best results? Normally, that question sounds extremely easy because we talk about trading. So maximum profit should be the target, and what else? But think about it. So just to maximize your final end profit of that trading strategy, looking back for a history of maybe 10 years, maybe 1 year, whatever, think about you have earned finally 10,000 euros, but in between, your account has been hugely to the minus. So just maximizing the profit is maybe not the best answer to the question, what is the best trading strategy? So there might be another parameter, like, for example, a minimum drawdown. So you know that the drawdown within an equity is the strongest losing sequence, and the strongest losing sequence does not mean successive loser trades. No, it's meant from a local maximum to the next minimum. And if that is a huge distance, then this is a drawdown within an equity curve. Give you on the next slide an example, then it becomes much more obvious. So the question, once again, what is the best trading strategy or the best results, the best equity, turning around a little bit with the descriptive parameters, in this case, EMA, stop loss, and take profit? It's not a straightforward question. So we should dig into that topic a little bit more to come to one single key figure in order to answer that question. But let me give you an example. Within that slide, you can see 4 equity curves. All start at an account of 1,000 euros, and then you have 4 equity lines here. And back to the topic of maximum drawdown, for example, within the red curve here, the maximum drawdown would be from here, where my cursor is now, down to here. That is let's call it the highest or the strongest drawdown sequence within those nearly 1,000 trades. We have maybe a similar drawdown here and maybe a similar drawdown here, but the maximum within the red line will be here. So now the question to you, and just use the chat here, the question channel, to answer the question. What number of equity lines, 1, 2, 3, 4, is the best one here? So which one you would prefer being your own account? It might be the red one, so equity line 1, or maybe one of those other ones here. So the red is definitely the one with the highest profit, no question. So total gain is about 4,000 euros in this case, and all the others have less good results. But the question is now, what is the best answer? What is the best equity here out of those 4? Now I got talking long enough to give you the chance for some answers. I got a couple of answers, and I can tell you all of them are absolutely right. The best one here, and I can simply switch to my next slide. The best one is equity line number 2, and you might ask yourself why. So it's definitely not the one with the highest profit. Within those 4 equity lines, it's the one with the third highest profit. So there's only one line below. But nevertheless, this one is definitely the best. Why? So we have a couple of things here. We have a positive slope, which is fine. So we have an increase in our account. And then the maximum drawdown, even if I don't know the answer in numbers, is quite low. So compared, for example, to the red one, it's definitely something totally different. Finally, if you think about that equity line 2, you might even leverage every trade higher, or to say it a little bit different, you might double your risk per trade if you have a trading strategy which gives result like equity line 2. So we can easily double our result, and maybe we need a factor of 3. Then finally we are in the same region like equity line 1, But still, even if you do it just by eye, you can see that the maximum drawdown would still be less than the red one. So you see already two aspects we need for judging equity lines. One is the slope, and the other one is definitely the maximum drawdown within that equity. So, and that brings me finally to my key figures I use. And I will jump back to the slide in a minute. But so my useful key figures in order to optimize any given trading strategy, I start indeed with the slope of the equity. And what is nice, or what would be nice, is to maximize the slope. The higher the slope, the more profit. Perfect. But on the other hand, simultaneously, we need to minimize the maximum drawdown. So the perfect trading strategy would have zero drawdown, and you will never reach it, but that is sure. But to minimize the maximum drawdown is definitely a good idea. And finally, I use one additional aspect, and that is a key number which stems from regression lines within whatever you do, and that is called the linearity. And that number, and I quickly jump already in something I will present later, because here we have an equity curve, and you see already the final result for an equity of mean reversion strategy. And what is within that equity is a regression line. In this case, the regression line is simply calculated by Excel. And you can see within the chart the formula of that equity. But there's another key figure you can use, and it is called R square. And that R square is a key number to describe the linearity. And if you would have an R square of 1, it would be a perfect straight line. And if you would have an R square, then it would be random noise. So then you would have huge deviations around that equity, or around that regression line. So since we all like linear equity curves, I can put that number into my calculation again. That's a little bit doubling the impact of drawdowns, because if you have huge drawdowns, that will ruin the linearity as well. But finally, linear equities are quite well, and we all like them. And now, if you have those three numbers calculated, we can construct a single number in order to judge any equity. And what we do is simply we calculate the quotient of maximum drawdown divided by the slope of the equity. Think again about the maximum drawdown should be minimized and the slope should be maximized. So if we have those two numbers in a quotient, then we want to have that number being minimized. And I simply call that number profit factor. It's a little bit misleading, sorry for that, but that name was already created 5 years ago when I started with those kind of trading strategies. And so I want to minimize that profit factor. And you see what happens. If you minimize that quotient, then you simultaneously maximize the slope and you minimize the maximum drawdown, and you balance both. Finally, my key figure is simply called opti, and that is once again the same, the profit factor divided by R square. And then, since that number has values between 0 and 1, so it 0.9 would increase that quotient, and therefore, once again, I want to minimize that single number. And it's extremely good to have a single number when we talk about equity curves, because when we have a single number, then we can play around with our descriptive parameters of a trading strategy, like EMAs, stop loss in percent, or whatever, whatever parameter we have. And we can always calculate that single number. And now we have even mathematically correct optimization problem with one key figure. And that's ideal, because then we can do things automatically, and we don't have to look to equity lines by eye in order to judge which one is better than the other. I make already the remark here that we have to avoid over-optimization. That will be in the future webinar a special topic as this one here, and how to do that. But generally speaking, what do I mean when I talk about avoid over-optimization? Simply think about a trading strategy which gives good results with an EMA of 200, and think about you change that EMA period to 201, and it would ruin your equity line. Then you have done what is called over-optimization, because I would not trust that kind of trading strategy, which is good at 200 for an EMA and bad for an EMA 201. The story would be different if I talk about EMA 4 and EMA 5, because then percentage-wise the difference is much more pronounced. But for 200 and 201, I think we all agree that this would not be a good idea to have that kind of trading strategy. One other remark here about optimization, it's a little bit the question of if you want to come by car from village A to village B, then the question is, what is the best route to come from one end to the other? And then the answer would depend on how to optimize. It might be the shortest distance, but it might be the fastest travel, or it might be the one with minimum consumption of gasoline or whatever. So you need such a key figure in order to optimize something. And we want to optimize trading strategies, and I personally use that kind of number, which is simply called Opti. And if you think a little bit longer about the quotient maximum drawdown divided by slope of equity, that is quite a cool number, because a typical number would be, for example, 600. And that number would tell you already something about the minimum account size versus profitability. So if you want to earn €1 per day and you would have a profit factor of 600, that would mean you need an account of €600, and you would suffer at least once within that equity line a drawdown of €600. I know that if that would be at the very beginning, you would get a margin call, but that's only practical trading. So but you will realize the meaning of that factor, and I can promise you that needs some time to get that meaning. For me, it was the same. But anyhow, we know what we want to minimize in order to get now best trading strategies. Good. But now direct into the topic of the main topic of today, mean reversion strategies. And I mentioned already with the picture a few aspects of that trading strategy, mean reversion trading strategies, the picture of the advertisement. So the basic assumption of the mean reversion strategies is the following. Think about there is a fair price for a given underlying. That's up to now only a statement. But let's assume there is one. Then, of course, that fair price should not wiggle around that fast. I mean, if it's now 1.58 within the next couple of minutes, it not should change dramatically. So that would be a fair price. How to define that fair price precisely? We come to that topic, and you will learn that we don't need the real meaning of what is a fair price of an underlying. But at least we need something we think which is more the smooth value, the one the price wants to be. And that means that the actual price, and you all know charts with huge deviations up and down and so on, the actual price might deviate from that fair value. And the next hypothesis here is simply that whenever we have huge deviations from that fair price, then the price will tend to come back to the fair value. Let me simply give you an example within the chart, and I think I have here one already within the slides. So in this case, I have, in this case, it's Australian dollar, US dollar on an M15 chart, but it doesn't, I don't care really about the underlying and the time frame right now. So assume we have an EMA within our chart, and you can clearly identify extremely good trading possibilities just looking to the EMA and the actual price. Exactly here in the middle, we have a very good situation. You see, we have a huge deviation from the EMA, and now a short trade entered here, opened at that point in time, would be a nice idea, and then the price goes back to the what I now call fair value, or back to the EMA. And you can see there are other possibilities even within that maybe 50 candles here, that we have whenever we have huge deviations from the EMA, the price tends to come back to that EMA. The question immediately is, hey, what EMA should I use and when should a trade be triggered? So when is the deviation huge? Because up to now I only use that word huge and does not give you any clear definition. But at least what we can see is, think about this phase here. There we don't have huge deviations from the EMA. So in this case, we should not open any trade. Only if we have that real huge deviations. And that brings us back to possible definitions for such a fair value. Since I don't know exactly what is a real fair value, I can simply use other values, just name them the fair value. So, for example, I can use an EMA or an SMA, and finally we will use an EMA, and the only reason is that is the way how to calculate it in Excel is much more it's easier to do it with an EMA than an SMA. Finally, I'm sure that would not really depend on EMA or SMA. You might think about other things, how to come to a fair value. You might use the chart itself, and put a regression line into a certain price history. Just to give you an example, what I mean here, let me switch here to a chart, and now let me at least make one here a little bit bigger, and let's zoom a little bit. And now we have a chart functionality which is called channel, and there you have one thing which is called linear regression, and that is something you can simply draw here. And that means we have now the chart is fitted by a straight line, and that means we can think about that value here is fair value. And now we can ask, okay, we have a huge deviation from that fair value. We should now open a short trade so that the price comes back to that fair value. So that might be another possibility to come to a definition of a fair value with some certain history, whatever. Then this would be the number we have to optimize. What is the number of candles for that regression line? And then once again, we have to think about what is a huge deviation. So that's all. So that's simply a regression line here within the chart. So that would be another possibility to have a definition of a fair value. But even other values might be of interest, just values from higher time frames. We simply can define that maybe the Friday last price of whatever we call the fair value for the next week. Or within a day at 4 o'clock, the EZB, European Central Bank, announce the reference numbers for euro, US dollar, and then we call that the fair value. So there might be hundreds of definitions. And finally, our trading result, of course, is always different, but we can optimize everything in order to come to a good trading strategy. But now, really, what does it mean if we have, or if we think about trading rules for that specific setup, mean reversion trading strategies? The basic idea, I think you got it already, that the price comes back to its fair value, therefore mean reversion. So coming back to the mean. And the trading rules and the parameters we need for that kind of strategy is nice spelling error here. Our degrees of freedom, or parameters in order to describe our strategy. One will be an EMA period. Okay, that's easy to define, and we know what to calculate, and even within a chart, we definitely know what we are doing. Then what we need is that deviation from the EMA. And that's how I would do it. I go for the close price of a certain candle. And now I create the difference between the close price and the EMA value, like we did visually in the chart. And I would go for the absolute value of that divided by the close price. Why? Then we have something which would be more like a percentage deviation. So the higher the number, the more deviation we have. But we are in line with DAX values now 12,000, 10 years ago at 2,000. So if we have that percentage definition, then we are always on the safe side, even if we get totally new prices like the DAX values I mentioned. So, and whenever we exceed a certain threshold, then we would open a trade. Finally, what we need is a stop loss. A stop loss, for example, in percent of the price, and that we have a given stop loss for our trade. And now back to the question, we always need entries and exits. So a trade is opened if the threshold is exceeded. Okay, well understood. But now when to close the trade, because we don't have a take profit within the trading rules. And the simple trading rule would be, for example, when we cross the EMA based on the close price of our candles, once again, then this would close our trade. Let me show you that within our chart, and you still remember, hey, here would be the ideal point in time to open a short trade, and that trade would be closed here. Why here? Because there we have a close price below the EMA. And now we can do different things. We can do, on the one hand, that's what we will do in the next couple of minutes, we create that strategy within an Excel sheet. Or what you can see already, how to use it, you can do it discretionary directly within a chart. So whenever you encounter huge deviations from a given EMA, then you can think about, should I enter a trade? Yes or no? And then you can manage that trade by your own. So it's not only a machine-like trading strategy, you can use it for your daily trading activities as well, simply by looking to the chart. And the good thing is that since we have always a little bit history within the chart, we get a good feeling of what is a huge deviation. And for example, if we would be exactly here at the end of the chart and think about, you would ask yourself, should I enter a trade now? The clear answer would be no, at least not according to this strategy, because that close price of that candle has not a huge deviation to the EMA. So that would be beyond any question, and we would not open a trade according to this specific trading strategy. But what we can do now is we can calculate things directly in Excel, and we can have single lines for every trade and whatever. So, but that are the trading rules. Now let me jump once again to that Excel sheet here. I used already in order to show you what a regression line is. And what we have here is an Excel sheet exactly for that kind of trading strategy. And I don't want to guide you completely through that Excel sheet, but let me at least only here the very beginning. So we have to calculate an EMA, that is a simple formula here. And then you see what I use here, in this case without absolute values because I do it later. We have that deviation in percent, and then we use a certain threshold, and that would trigger a trade. Finally, what we additionally need is we need a rule like whenever a trigger comes and we open a trade, then all next triggers for additional trades are ignored. So we always have maximum one trade open. So for example, here you can see I have 3 times the trigger for a long trade, but only the first one would be used to open that trade. And only if that trade comes to an end, then with the next candle, we can open the next trade. So the trade here down to the right of that Excel sheet, there the trade is managed, and of course we have a stop loss value and so on and so forth. You see already here still something like a risk-reward ratio. I don't use it really, but the Excel sheet is already prepared for a take profit as well. So then we would have two alternative trading ends. One would be the cross of the EMA, and the other one would be that we might hit our take profit. But since I use here extremely huge numbers for risk reward ratios, we will never reach the take profit. You see within that Excel sheet as well exactly the same key figures I have introduced today, like profit per day, which would be the slope, maximum drawdown, profit factor, R square, and finally Z opti. So that is a number which we want to have which we want to have minimized. How? By changing, for example, EMA values, like what I do here, and you can see each time you see a different equity line here, and you might have seen that it becomes worse when I went upwards here with my EMA. But what I always do finally, I simply look to exactly that number, or we can change that threshold, for example, to other values. Then once again we get new results. And now we are back to the question, hey, we can optimize that trading strategy simply by changing three numbers: EMA, the threshold value, and the stop loss in percent. One additional remark, what you always, if you try to use this Excel sheet for other underlyings, please don't forget to change the spread value, because that should be within the trading strategy as well. So if you would fill in data, for example, for Euro US dollar, please don't use a spread of 0.03. You will see that ruins every trading strategy. So you always have to use the right numbers. So now one thing is what we can do is we can simply change those numbers. The other good news is, or the other, what we can do here as well is, and now I change to the other Excel here, and that's the same Excel sheet. The only thing what I want to show you here, that I can do that optimization completely by computer power. That means I don't have to change those numbers by my own and then try to find the best combination of the three values, EMA, threshold, and stop loss. I can get help or assist here from what is called the so-called solver. And that means I have to specify what number should be minimized in my case, and then I give value ranges for those different parameters like EMA, threshold, and stop loss, and then I simply have to press that button. And now it might take some minutes to get the best results. I have to mention here that that kind of algorithm which is used here from Microsoft does not automatically get the best numbers. There is some randomness in that optimization process, and therefore I can only tell you try to do it several times in a row, and you might get different numbers, and then you simply go for the best ones. But that's only because of the algorithm which is used here, and so it takes some time. In the meantime, let's do the computer that job. us in the meantime look, can we do similar things for other underlyings? And the answer is yes, we can. And in this case, we have DAX values, and you can see here, once again, an equity line. We can change a little bit the numbers, and it might get better or worse. The funny thing here is that there's a long period without trades. Okay, in this case, the deviations have been not huge enough. All the data here are daily data, but you can use more or less the same thing here for intraday, H1 data, whatever. The only reason I don't do it within the webinar is simply the Excel sheets get very slow, and therefore it's not that good to show it, because sometimes it's too long time. And just another example here, that is S&P 500. Interesting fact, we have here a period with not that much trades as well, and it's the same point in time. So there must be something more behind that we don't have huge deviations within that period of time. But still, you can see, hey, good results. We can have get a good increase in our equity. From the three I show here around, the Brent is definitely the best. No question. And hopefully our solver gets the result, because now it should be the time that I can share those results with you once again. In the meantime, now it's ready. Okay. And now you might remember that we started with an opti of about 700, and now we have an opti of about 300, so a much better result. That is the equity with 1,600 trades, so it's definitely a statistic. And you might wonder, because we have an EMA of 15.3, and you can't enter those numbers within MT4, but don't worry, if I go for 15, it will not change the result that much. So that's a quite good trading strategy, automatically optimized by the computer or by the Excel sheet itself. And that kind of equity, and the units of the y-axis here is R. That means the risk unit. You can think now about real trades, and if you always would invest 100 euro per trade, then you can multiply all those numbers here with 100 euro, and you have all the results in euro. Of course, we have an equity with drawdowns, and I can tell you the maximum drawdown is about 100 within that equity. We have phases without any profit, yes, but that happens always with any trading strategy. We have steep increases, flat behaviors, and we have drawdowns. But anyhow, that sounds like a quite reasonable trading strategy. So that is really a very good result. Next step would be to change once again those parameters a little bit and see whether we get immediately quite worse results. If that would be the case, then we would have over-optimized that kind of trading strategy. But back to how to use it. So one is, of course, we can now open a chart, Brent, daily base, put an EMA of 15 within the chart, and then we calculate always the difference of the actual close price to the EMA. We look whether we exceed the threshold, and then we would open the trade. That's all. Still the other idea, because I want to do that here maybe once again, and let me simply change time frame just to see can we do similar things even by eye within the chart, and you can clearly see The answer is yes. The good thing, for example, yesterday evening, I have had the same webinar in German, and I went for the same chart, Euro, British Pound, H4, and yesterday we have been around here, and I took exactly that example here. Hey, it looks like we get a good time for opening a short trade in Euro, British Pound. And okay, statistics one, perfect trade would be closed, I think, nearly 24 hours later with a good profit, no question. But that's statistics one. We all know that within those kind of strategies, we don't have always winner trades. And just one moment, just one step back here, that you see what we have here. We have a win rate which is not that huge. So that means there are quite a lot of trades, like when I do it here within the chart, we always go for stop losses which are not that far away, and therefore the probability to run into the stop loss is in principle high. But in case of a winner trade, we have really very good results, and you can see directly within the chart other good trading chances here within that chart. But of course, you find examples with loser trades as well. For example, here, I would say, yeah, huge deviation, opening a short trade, starting good, but looking at least to the complete trading rules I presented here, we have not crossed the EMA here. So that would have been a loser trade. I'm always that honest to show that results as well. So we don't have always winner trades. But nevertheless, we have quite a well trading strategy here. We can manage everything within Excel, for example, in this case on a daily base. But you can do similar things on other time frames as well. And you can use those kind of functionalities like the Excel solver in order to get the results optimized. What you need is a single key figure, and for me that single key figure is that number opti here. Good. Back to the slides. Although we are nearly up to the end of that webinar, I think you have seen that mean reversion trading strategies can be used twofold. Yeah, you can use it directly within the chart simply by comparing the actual price to a given EMA and look for huge deviations, and automatically your eye will guide you of what is huge and what is not huge, because you always see a little bit history of the chart in order to judge that situation. But even what you can do is you can do it completely electronically here, like in Excel, in order to come to a fixed strategy with fixed stop loss, fixed EMA, and you can optimize that trading strategy simply by your own. So two possibilities to go further with that strategy. It's the mighty tool, mean reversion, because it's based on the assumption that the price comes back to its fair value. The only thing is always we need a definition of that fair value. But even if we use other kind of definitions like regression lines or higher time frames, you will see that we can get quite good results as well. So that's for today. Next webinars will come next month. You will always get an email, or you look to the webpage from JFT Brokers. There are tons of webinars around, other speakers as well, really good speakers, I can tell you. So I can only recommend, look to the calendar of JFT, and hopefully we see us back even with my next webinar in July. In the meantime, if you have any question, just send an email to this complicated email address, s.friedrichowski@jftbrokers, or you have downloaded the slides already, then you find the name within the slides as well. So that's for now. I hope you enjoyed the webinar. I wish you a good evening and a good week, remaining week. So enjoy your time. Bye-bye.